Thanks for clicking. Canada's housing bubble has burst and it's time for Canadians to brace themselves. This was the message coming from David Rosenberg in an article published in the Financial Post. Rosenberg argues that falling real estate values and the resulting negative wealth effect, where consumers spend less of their disposable income despite their income remaining unchanged, will result in a major recession in Canada.
I told you this was dangerous.
The article by Rosenberg comes alongside RBC's most recent report on the Canadian economy, which says that Canadians have already lost $900 billion in wealth and more is yet to come. Given that the Bank of Canada has said it will raise rates into a recession, and many are saying that the recession is coming sooner rather than later, it's important to understand what that recession is going to look like. So what I want to do today is go over Rosenberg's article on how the negative wealth effect and declining real estate values will lead to a contraction in Canada's economy, go over RBC's report on how much wealth is leaving Canada's economy, paper wealth or not, and then discuss what to look for next. The first of the month is upon us, so October's real estate data should start trickling in from the local real estate boards. We'll obviously have an update out on October's data on this channel. Click like and subscribe to get those updates, but for now, let's get into Rosenberg's article. Rosenberg's article starts by accepting the premise that Canada's real estate prices will fall by 30% from peak to trough. This is well in line with predictions by other big banks, which have also predicted a 30% drop in Canada's real estate prices by the time we hit bottom. The article then moves on to the wealth effect. Canadians spend more when they feel wealthier. Throughout the pandemic, spending was on the rise, not just because money was cheap, and it was, but also because house prices were on the rise and Canadians felt richer. Indeed, by the third quarter of last year, house prices were up by 14% year over year, and Canadian consumers had powered our GDP growth rate to an annualized 5.4% in the third quarter of last year, with Bloomberg reporting that Canadians can't spend money fast enough. But Rosenberg argues that that is all over, and the same wealth effect that caused all of the spending will now be reversing, pulling billions of dollars out of the economy. While the Bank of Canada raising interest rates by 350 basis points over the past year is obviously going to pull a lot of money out of the economy vis-a-vis higher interest costs, Rosenberg says this is only going to be compounded by the negative sentiment caused by a 30% reduction in our house prices. As Canadians feel less rich, they will spend less money. If real estate prices fall by 30%, Rosenberg says Canadians will spend about 5% less, which will translate into a 2.5% drop in our GDP. That's a big contraction caused in large part by paper losses. Losses in accumulated wealth, paper wealth, that has real implications.
I'm very important.
So we have a 2.5% drop in our GDP caused by the negative sentiment resulting from falling home prices. And added to that, we have a major slowdown in trade resulting from a slowing economy in the United States. Rosenberg says that Canada hasn't had all of these factors working against us since the early 1990s, when the Bank of Canada induced a recession. Given the negative wealth effect, higher borrowing costs, and a slowing economy in the US, Rosenberg says that Canada could be in for a much worse recession than is currently being predicted. The new report by RBC echoes that of Rosenberg's, with RBC saying that Canadians amassed $3.9 trillion in net worth during the pandemic, mostly from higher property values, and that wealth is quickly evaporating. Indeed, RBC says that by the end of 2022, $1.1 trillion of that accumulated net worth will have evaporated due to falling home prices, and by the end of the real estate correction, by the time all of this is over, $1.6 trillion of that paper wealth will have been lost. Given that an early Bank of Canada estimate said that for every $1 that Canadians lose in net worth, they reduce their spending by 5.6%, this would lead to about $100 billion less being spent by Canadians. So between these two reports, the article by David Rosenberg and the report by RBC, the common theme is that falling house prices has a real negative psychological effect on the economy. As Canadians see their wealth disappear, paper wealth or not, they spend less. So even though the gains may have only been on paper, the effect of those gains being lost is real. The reduction in the perceived wealth on behalf of Canadian households will lead to a reduction in voluntary spending. And I stress the word voluntary spending as there's also involuntary spending going on throughout the economy. As Canadians with adjustable rate mortgages are paying more, those with lines of credit are paying more, those buying cars, all are paying higher interest costs than they have over the past 15 years. And with more money going to the banks, that means less money is going into the economy. Less money is going to renovations, to cars, to restaurants, to travel, etc., etc.
I'm okay with that.
And make no mistake, this is what the Bank of Canada wants to happen. They want Canadians to reduce their spending. They want this negative wealth effect to happen. They want the economy to slow down. We talk about quite often on this channel about when will the Bank of Canada stop raising interest rates. And I think the Bank of Canada needs to see that they have caused some damage to the economy, that they have caused some unemployment. That will be the real-time indicator that the interest rate hikes are having their desired effect, that they are hurting the economy. The idea, as Tiff Macklem has said, is to cause some short-term pain in order to avoid even more pain in the longer term. Governor Macklem has also said they are more than willing to cause a recession to get this inflation rate under control, and by the looks of these two reports today, a recession is very much what they might cause. With that said, we'll obviously continue to track Canada's economic development on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.